And now let's shift focus to the aviation sector. Airlines around the world could be among the biggest beneficiaries of easing tensions in the Gulf. Following US-Iran peace negotiations, oil prices have retreated sharply, pulling jet fuel costs lower. In the United States, jet fuel prices have fallen from nearly $4.9 a gallon in early April to about $2.85 a gallon in mid-June. If those levels persist, Reuters estimates that the U.S. airline industry could save more than $40 billion annually on fuel expenses. Now, fuel is typically one of the largest operating costs for airlines, making the recent decline a significant boost for the sector's profitability outlook. Despite lower fuel costs, passengers should not expect immediate fare relief. Airlines have spent months raising ticket prices, baggage fee, and trimming flight schedules to offset soaring fuel bills. Even then, carriers recovered only a fraction of their higher fuel costs through fares. In fact, industry estimates suggest U.S. airlines recoup roughly 60 cents of every additional dollar spent on fuel, while some carriers recovered much less. As a result, airlines are now likely to use lower fuel costs to rebuild margins rather than reduce ticket prices. Another factor supporting higher fares is limited airline capacity. Aircraft delivery delays, airport constraints, and cutbacks by low-cost carriers have reduced the risk of a broad fare war. U.S. domestic seat capacity is expected to grow just 0.4% year-on-year in the third quarter. That's far below earlier projections. Analysts say this gives airlines unusual pricing power, even as fuel costs decline. While some long-haul routes in Europe or selected markets in the Gulf could see promotional pricing, the broader industry is expected to prioritize earnings recovery. For consumers, future ticket prices may depend less on fuel costs and more on whether travel demand remains strong in the months ahead.